This is our Forex blog for August 29th, 2012. We released a new version on Monday, and one of the new features is our new FX Build a Trend currency meter, which has different weights, different settings, and it's more influenced now based on intensity-based tools versus direction. We have tools that show you which direction, for instance, the Swiss is moving versus all the rest. And we have tools that show you the intensity of that Swiss movement versus all the rest. We average it together into one nice reading here. Now we are using much faster range-based bars to calculate intensities and directional tools, and it's very quick in identifying a new trend. The real-time trends on the top, 15-minute, hourly, daily, weekly, monthly. So when you see most of the long-term trends being up, and the first green bar here at 357 shows some strength, find one that's extremely weak. This one's already weak ahead of time. You could obviously sell the New Zealand Swiss a little bit before 4. And in fact, because the New Zealand already got weak beforehand, but you can see it fell another 23 pips to be exact from that spot. You can sort the currency meter to see the strongest ones on top, the weakest ones on the bottom. There's so many easy ways of trading using our tools. The CAD, extremely strong today, especially after around 7:30 right here. Anytime you see a lot of strength followed by very little weakness, that momentum is likely to continue. It's even more likely to continue if all the other time frames are strong. You can see the daily trend's down, however the weekly and monthly trend are still up, and you could be looking here for a very high probability trade at 8:30. Which would you trade it against? Probably the yen, which is one of the weakest. All the time frames are down except the weekly trend, and it's shifted to just barely up during that time. So you want to buy the strong CAD versus the weak yen. Let's bring that chart up. Here's the pound yen with the colored bars. Anytime you see it break out with dark green bars, you wait for a pullback. I like to draw a trend line underneath the bar's highs. You go along right here, you can see it went up about 15 pips. Another pullback, the bar went from light pink, which means there's not much weakness on the pullback, to green. You buy it, you can see it went up another 20 pips. This one pulled back with a little bit of intensity, but it just broke the previous day's high right here. When it goes back above the previous day's high, I typically will go long. I would prefer these bars to be green or this bar right here to be kind of like a light pink like that. But you go long and you want to see the bars go dark green, and once it goes up to the Fibonacci profit targets I do each night, these are likely to be the max high, and you can see that they were. Another way of trading that I've been doing lately is bringing up a quote sheet or a hot list. In this case, put your currencies on there and then add underneath here inactive scripts, value area, day, and week. This shows you which currencies are above yesterday's most traded price, last week's most traded price. It shows up as light green, light red on both the daily and weekly if it's above the point of control. And if it's above the previous days or weeks upper value area, it's dark green. So it tells you a lot of information based on the color and when you sort it. If it's underneath the previous day's most actively traded price, point of control, but not yesterday's lower value area number, it shows up as light red. If it's underneath yesterday's or the previous week's lower value area, then it's dark red. So basically, if you sort this, you can see the New Zealand yen, New Zealand dollar are underneath not only yesterday's average price, last week's average price, but they're both underneath the value area low. So what you can do is bring up the New Zealand dollar and just simply wait for it to break the 30-minute or 60-minute intraday value area. This is such an easy way of trading, and it really works. I've been taking quite a few trades off of this myself. Here you get a pull back up, and always wait for it. I like to see it cross from above to below. This one happened to open up underneath the value area for the previous hour. So when it came back down right here, you're short, your stop's above here, you got the whole move down. Then the market rallied up. Now in this case, it opened up underneath here. I prefer to go back above this area, then back down. but it found resistance here. It couldn't get above it. And anytime that happens, you go short when it goes a pip underneath that bar, and you caught a trade pretty much from 50 all the way down to 20. 30 pip move. Let's look at the New Zealand yen. Remember, we're looking for sells because it's underneath the previous day's point of control, the yellow line on our intraday value areas, in the orange weekly point of control. So here it went above it and underneath. You go short, pretty much caught that whole move down too. This one rallied up, and because this previous hour it spent most of its time right here, that's where the most trading activity happened. It's for this reason that if you see a big move up, and this is where the previous hour's value area is, you might want to, on a case-by-case basis, switch to a 30-minute, and it can oftentimes help you find trades that you sometimes can't find on a 60. Here is where the previous half hour spent most of its trading activity, 63.29. So it opened up underneath there, came up, found resistance. You go short, and you can see it dropped. Here it opened pretty much above the previous 30-minute point of control and broke it and dropped. It fell, 10 pips, and it's a pretty high probability way of trading. Let's look at currencies that are above the previous day's point of control in previous weeks. We got the CAD yen, dollar yen. So let's bring up a CAD yen chart, and I'll put the 60-minute back on it. This is just a new way I found to trade. I like it. It's very simple. The hourlies are going to give you typically more pips when you spot a good signal than the 30s do. However, don't let that dissuade you from trading it. So this one, it had a pullback down, and in this case, it found support here. You might have went long right here. You had a loss, all right? Then it found resistance there, and during the next hour, it broke, the previous hour's point of controls here. The 2 hours back is right here. When it broke above that, you go long. You can see it went up about 10 pips, pulled back, went above it, and you caught this, decent sized move up, 25 pips. And you might have also went long right here, 65. You made another 10 pips. Pulled back, found support here, and you can see, shot up again. Actually shot up is not appropriate. It inched its way up, and you would have made 5 or 10 pips on that trade. I don't typically trade the dollar yen much. But you can see today it's above the previous days and previous weeks value area. So we'll bring the dollar yen on here. This one typically doesn't move too many pips. You can see this move up was about 25 pips. And it's always better when you find these trades when you get a decent pullback like this, and then it goes above the previous hour's point of control, shoots up 10 pips, finds support here, goes up 7 pips. And, if you went long right here with your stop underneath here, you would have had to sit through this about an hour, then it shot up one more time. And last but not least, to end today's class, Forex blog, use the Fibonacci profit targets to get out. Most of the time I exit the first half. When it hits the 1.382 fib target, I'll get out of half. And if the trailing stop gets triggered, I will get out of the second half. If it goes up and stalls at the 1.618, 80% of the time, this is going to be your maximum profit. So if you had, kind of saw this thing go sideways here and broke out, let's say about 78, 65, you got out of the second trade with 12 pips. And for the new traders out there, if you get 10 pips per day, you will do very well consistently. 50 pips a week, 200 a month. If you bring up our trade analyzer planner, you can see for yourself. You can double your account every 2 months by getting just 10 pips per day. $2,000 account at the end of 2 months, it's pretty much doubled. 2 more months, it's more than doubled because we're not using fractional. We're just incrementing this by mini lots. When we first created this tool, brokers really did not have micro lots, so that's why we incremented it in mini lots. I might have them redo this to allow people to have the exact number of lots that you can now trade that 5-6 years ago really wasn't available. Here we go, another 2 months, doubled. And obviously the power of compounding $2,000 account into an astronomical amount by just getting 10 pips per day. So think of that every time you take a trade that you're not sure about. If you lose 10, 15 pips on this, you just lost a day and a half's worth of minimum profit. If you get 10 pips a day, it's going to take you another pretty much 2 days just to get back to even, and you're going to end the week, if you have a 10 pip day, on Friday, you're only going to end the week up 10, 15 pips. You're 35 pips underwater. So be careful. Try to take trades that you feel are 50 to 80% likely to work, and also likely to work and give you, if the trade does pan out, 2 times or more profit. In other words, if your profit target's 20, 25 pips away, 30 pips away, and you're risking 6 to 10 pips, that's a great trade. A trade that has major resistance in selling, 10 pips up, and you're risking 10 pips on the trade, is not a good trade. Now, I will occasionally take those trades myself, I'll be honest, if I feel the trade's 80% likely to work. It's a super, super strong trend. It's above the upper containment band. That makes it a lower odds trade. But it's so strong that I'm very likely to get 10 pips. If it's the first trade of the day, I'll trade a little bit less lots on it. If I have a good day and I'm up a lot, I'll also cut back a little bit so I don't give too much back on the day if the trade doesn't work. But most of the time, when you gain experience, you'll know which trades tend to work and which ones don't. But for new traders, take trades that are 50% or more likely to work, that are going to pay you 2 times more if they work than they don't work. I'll show one example of that. Let's just bring up a random currency, Euro Yen. Here the market's kind of chopping around. Previous days, previous weeks, point of control. The momentum is mostly to the upside. So if you took this, breakout right here, 98.70, you have a profit target right here, 8 pips up and 12 pips up. That does not really make a good risk versus reward trade. Now, obviously, their odds are slightly up. The daily trend's up, the weekly trend's up, monthly trend's up. It's fine. Major resistance here. So if it tries to get above an area and can't, and does not pull back and go lower, it's eventually going to try to go higher, and you're going to probably get 10 pips. It's not worth your risk. Let's find another trade that is worth the risk. Actually, before I do that, here's the previous day's point of control, previous weeks. When it breaks that area right here, it's likely to go down to the next profit target, which is down here around 43. If you're short at 59, you're likely to get 15 pips. So that's 1.5 times bigger profit target than your risk. Not a bad trade. Not the best trade, but one definitely worth taking. This is a better trade. The market shot through this fib area, the previous day's high. It went up to the 10-day moving average and 200-day moving average up here. It's also the weekly pivot. Major, major resistance. And the more areas at a certain price, the more likely it tends to act as a magnet. So you got a decent pullback right here. It went underneath the previous day's low. The weakness subsided, went back above. You go long here at 40. Your profit target is up here at 62. So, and as you can see, you made about 10 pips more than that. This is a trade where you risked. You would have went long here at 40. You would have put your stop underneath the low here at 33. You're not even risking 10 pips. You have a good chance of 30 pips, and you actually made 40 pips on it, or up to 40 pips. That's a 4 times bigger profit than what your risk is. If, as a new trader, all you do is just wait for those trades and take them and hang on, and even if you would have got out of the trade right here at 55, if you went long here at 40, you made 15 pips, you got 1.5 times bigger profit than what your risk is. Focus on getting bigger wins than what your losses are, and you should have a good, trading results.